Okay, so here's my predictions for the 2026 rate market. What is going to happen? Where are rates going to land? What's going to cause rates to do what? We're going to cover it all. It's going to be about a half hour. Hoping this information is going to help you either make a decision as a customer this year as to what's the right choice for you, your clients, the realtor, whatever, right? So let's dive right into it. So I'm going to outline my heat map of outcomes for interest rates. So I think we're red hot right between 5.75875 to 6.25375, right? Somewhere in that range, give or take an eighth of a point from that standpoint. I think that's the red hot area where it just makes the most sense with what I think I'm seeing in the tea leaves for data points, where the market's going, all of it, right? Which will kind of cover some of it. And then I think it's a little warm underneath that level, right? And then I think it's a little warm just above it, not as warm as below it. I think the likelihood of 5.5 is slightly better than the likelihood of like 6.75, right? Like just by a smidge, but not by a lot. And then I think anything really below 5.5 gets really cold. I think it's really hard for rates to navigate to that range with what's happening right now. And then anything above 6.75, same thing. I think it gets cold, but it's like a little inverse flip there. I think we could easily see 7% as a 30-year fixed rate again this year before we see 5% or 4.75, right? There's just more rebound effect that could happen. One bad inflation print, something like alongside of a good jobs report, and all of a sudden sevens, boom, right there, right? So whereas it's going to be a harder hill to navigate back down below 5, there's way more pressure for rates to stay elevated than there are for them to be much lower, if that makes sense, right? At least as of right now, as of today, in January, early in the year, less likely, really low rates, more likely, low rates relative to the past few years, not what the consumer wants to see when I say low rates. If I walk up to anyone and say, hey, what's a lower interest rate? They're probably like 4, like I love 4, because that's where our brains go. Because most adults right now, the big portion of us being adults, if you're in that home buying window of, you know, 25 to 40, your adult life was like after the market meltdown of '08, right? Which rates have been low that whole time. So when we say low rates, we think 4%, right? But relative low sixes, high fives is much better than high sixes, low sevens, right? There's way more buyers that can be in the market. If you have a high six, low seven, you should probably take some money off the table and run, get a refinance, get into a new 30-year, get into a new 20-year and pay it off faster, whatever. The rate market's better now than it was at the worst of this cycle, which I think most consumers will take, but it's not going to be gangbusters like a 4%, number in front of a 30-year fix, right? So now that's my prediction. Let me dive a little bit deeper into like, why am I thinking that, right? Why do I think that's the range we're going to see? What am I reading for tea leaves in the marketplace to see that? Let's pull up some data here. I'm going to share my screen. Let's go ahead and share a second screen here. So the reason why we saw a big jump down in rates from this time last week to now, coming in from Thursday through the weekend, mortgage-backed securities have been performing very well, and it's because that the Trump administration announced that they're giving directive to the leader of FHFA, which is Fannie and Freddie, which they're still technically kind of controlled by the government right now. They're not independent by themselves. They're controlled by the government. So they can kind of have those conversations of like, do this, do that, to a degree or another. They have some cash on the sidelines. They're doing well as companies, if you will. So they got some money set aside. And he's saying, hey, guys, go in and remove some of the pressure from the mortgage market. Let's help interest rates a little bit. Go be a buyer in the market of mortgage-backed securities and go buy 200 billion, right? That is going to be good for mortgage rates. The market instantly moved south in terms of interest rates, and the value of mortgage-backed securities went up because that's what happens, right? As more money flows into this market, the value of these assets goes up. but the interest rate available to the client goes down, right? That's kind of that tug of war. So as they announce that they're going to be a buyer in the market, buying into the mortgage-backed security market as Fannie and Freddie, that's going to change the underwriting of buyers today of mortgage-backed securities because they haven't wrote a check yet, right? That's just the announcement that this is what we're going to do. We're going to buy 200 billion, right? So the market is a speculative one. So we saw rates go down pretty sharply on Friday. Most lenders from Wednesday to Friday probably had like a quarter of a point to 3/8 of a point better available. And where I really think the benefit came is the spread of costs to get a much better rate got a lot better because the low end of mortgage-backed securities really saw a bump jump up, right? Like that lower end that's, because there are 4.5% coupons available, but there's just no new loans going into that pool. There's just old loans that still exist and you can buy, so like those have a value too, and they're just a really low value, right? So like it's because they could go away, right? Like it's kind of a weird tug of war there, but that spread improved. And now it doesn't cost that much for all of a sudden you can do a 30-year, maybe in the mid fives, low fives. You just got to spend some money on it with discount points. That's available now, much better. But most par rate, which is not paying any extra costs, got a quarter of a point, 3/8 of a point better, right? So from that standpoint, the market's already kind of baking in this move by the admin, right? So this move might not have much more legs after this. And here's why. Mortgage-backed security issuance by dollar numbers, right? The value in the marketplace. This is in the trillions. So this, replace this with 4.5 trillion instead of 4,584 billion, right? Like that's 4.5 trillion, 1.5 trillion, right? 1.8. From 09 all the way to 2018, the Fed was pretty heavy in quantitative easing, keeping interest rates low. So they're a buyer in this marketplace this whole time, right? Really heavy during COVID to drive down interest rates to stimulate the economy as part of one of the moves there. So this is them also being a really heavy buyer. The Fed jumped out of quantitative easing in 2022, which means they're no longer a buyer, and started quantitative tightening, which is not even replacing their balance sheet. 2023 is the better representation of like no interjection at all, complete organic market movement. And what I mean by market movement is it's just the regular bond market doing its thing in terms of investors investing in fixed assets with the decision on why to put money into a fixed asset based on economic data points, right? No government intervention on either side of the coin. So that's what you're seeing for volume. Same thing in 2024, rebound a little bit. Rates are slightly better in 2024 than 23. If we look at this chart as opposite of rates, as this chart goes up, rates improve, it kind of makes perfect sense, right? Like 2015, 16, 17, 18, rates were between 3.5% to 5%, 5 being the high mark, 3.5 in 2016 being the low mark. And it makes sense, right? Like 16 being the low mark, highest volume, 18 being the high mark, lowest volume, and then up the river we go here and then back down, right? So, the 200 billion is going to help. It's not 1 trillion from the Fed. It's not going to have that same movement that inorganically moves it down, right? Because they were also buying the Fed during this was quantitative easing all around, which means they were also buying treasuries in excess of their balance sheet too, driving down the 10-year, driving down the 5-year, so on and so forth, right? So keeping their rate low, just pure stimulus this whole time, organic market. Whenever there's the government stimulus, rates have a chance at being below 6, far below 6, if depending on how much they stimulate. And anything above 6 is typically the regular market. And there's a lot of pressure from a regular market perspective on underwriting what an asset is as a loan from the standpoint of I give you money, get a rate of return back. Just that alone, it's really hard for rates to be below 6, right? And there's been a lot of talking points of the Fed rate, so on and so forth. So let me explain the Fed rate if anyone needs to know just the basics. And I'm going to replace how the Fed talks about their rate with what I think the actual viewpoint of their rate is. Is they have 3 quadrants. Quadrants is quad. So they have 3 sectors, right? So this forget about quadrant 4, but they have 3 like positions the rate could technically be on a scale compared to what the economy is doing. So forget about the amount of the rate, but they just have three positions the rate could be relative to economic data points. They have stimulus, they have neutral, and they have restrictive, right? So they view it and say, like, our rate right now is either stimulating the economy because we need growth. Think of this period, so really low rates. The Fed rate was essentially zero during this period of time and during COVID. And then we have a neutral rate, which means the economy doesn't need stimulus or restriction. So our rate is somewhere in the middle. Again, don't necessarily think in terms of the exact amount that the rate is. And this is the risk that, we faced during the COVID years and before COVID years, where the Fed rate was essentially zero. If you need to restrict the if you need to stimulate the economy anymore, you don't want to have to go negative, right? So so either way, we're already flirting with too low from that standpoint historically. But just think of them in these sectors: neutral, stimulus, restrictive, right? We've had a restrictive rate since 2022 into, they've deemed recently that they think they're closer to neutral, but still slightly restrictive, right? Because inflation's still not cooled. And the economy is still technically strong on paper, GDP, unemployment, all of that's still good. Wages aren't right where we want them, but those other categories are pretty good, and inflation's still sticky. So they're still technically restrictive, which means there's still spread for their rate to come down a little bit to get to neutral. Let's replace those. There's the brakes, there's the brakes on this side of the coin. There's cruise control, and then there's the gas. Because the economy is never neutral. There's never a neutral. It's either growing or it is receding. There's no in the middle. There's never neutral. There's cruise control. There's employment is steadily growing. There is GDP that's steadily growing. There is unemployment that's remaining low. There is inflation that's remaining stable and low, right? That's cruise control. That's not neutral. Cruise control just means that they don't need the rate to be too low to be on the gas and to stimulate the economy too much, because why, right? And then they don't need interest rates to be too high to restrict the economy, because why? Why do we restrict it? Don't hit the brakes. So it's just cruise control. They're thinking that there's still some wiggle room to get to cruise control, right? But the cruise control narrative will happen once inflation is nearer to expectations of 2% and stable for a while, alongside of a stable and growing economy with GDP above 2%, unemployment below 5%, right? Like, those are the metrics they're looking at with their dull instrument that they have, or their blunt object that they have of just an interest rate, right? They're trying to look at the complexities there and go, where's the rate need to be relative to the economy for us to achieve one of these three things: stimulate, restrict, or remain the same, or cruise control, right? So that's the Fed rate. But then the Fed also can do quantitative easing or quantitative tightening, which is their balance sheet. They can buy treasuries, buy mortgage-backed security, buy corporate debt. And what that really does is stimulates the economy on the street and moves interest rates on the street, right? Like, if they're buying massive amounts of mortgage-backed securities and they're playing as a market player in the market, they are going to move the rate down because they're displacing that market. Okay, so that's that tug of war from that standpoint. Now, in terms of the 200 billion, we just kind of showed you, like, hey, that's not massive. It's good. I'll take it. High fives. Way better than it was before. Again, if you're hearing this and you can refinance, do it. Take the money and run, depending on what your plan is with the house. Just texted a client yesterday. They plan on moving. Probably not going to refinance, right? Some other people were having conversations about how long are you going to stay there? Can we reduce term? Can we lower rate? Where's the savings at over 15 years, 20, 30, break evens? What are rates going to do? We're having these conversations because the opportunity is there with the rates being in the high fives. Where I'm saying, like, let's not hope it gets too far is now let's look at, why do I think a 4.99 rate is hard to get to, right? So we just kind of covered how the flow of money occurs into the bond market, that it impacts interest rates. But let's really look at that flow of money. The flow of money is typically stocks, fixed assets. And what I mean by that is, as an investor making a decision on, I'm going to put money somewhere and I want that money to come back to me greater than what it was when I put it there, right? Stocks is the number one for most people from that standpoint, right? And then you have fixed assets because fixed assets are boring. They're fixed assets, right? Like there's not a lot of big chance of making a big bet there. That's a very low gamble, right? Low risk, low reward from that standpoint. So if we look at like the relation there of the flow of money, we need money coming into the bond market for mortgage rates to be lower. You need a lot of money coming into it. Again, just kind of showed you that here from that standpoint. So we need a lot of money coming into it. From there, we also need the stocks to not be doing good in a weird way, right? So like it's a weird tug of war there because if we look at the spread of the 10-year treasury to the 30-year mortgage, historically speaking, that's like 1.5% to 2% during times of economic stability. So like when we're in cruise control to a degree or another, like just stable, like cruise control or even stimulus, cruise control or stimulus, that spreads 1.5 to 2, right? Right now, the 10-year treasury is around 4. Mortgage rates just made a leap down. They were somewhere in the mid sixes. 10-year treasury was somewhere around 4. That's about 2.5%. That kind of shows here, thank you, ChatGPT, that's when there's risk in the market because there's risk to buying a mortgage-backed security because that asset can go belly up if no one makes their mortgage payment, right? So it has risk. The 10-year treasury has, from a marketplace perspective, no risk because you really can't underwrite America going belly up completely because then there is no dollar and we have other problems, right? So like that's not even something someone underwrites because we have other problems if we're donezo as a country. Not good. So that's a 100% guarantee from an investor standpoint. I put my money here, I get a return. Only risk is complete dissolving of the dollar, which why even underwrite that, right? Buy a Bitcoin. That's the gamble there, I guess. But, that's the only way to really underwrite that. Buy gold, buy that, buy tangible assets. The tangible assets are the only underwrite to the dollar erodes, America goes away, but I have a tangible asset that's got value everywhere. That's it. So if you're not underwriting that risk, which again is not really important for my conversation, but just in case you were thinking it, from there, the flow then goes into other fixed asset, which is like mortgage-backed securities, corporate bonds, municipal bonds, right? Corporate debt, whatever you want to call it, just a fixed asset that I give you this amount, and there's a rate of return on this amount, and there's some sort of also inherent value on the actual certificate I get that I can resell in the marketplace. That's how mortgage rates move up and down, left and right, so on and so forth. From there, that risk spread, again, with times of not volatility or stimulus is between 1.5 and 2, as we can see here, right? But when there's risk in the market because we have market volatility, there's inflation, there's potential growth in the economy, stalling of the economy. It doesn't matter what the cause of volatility or instability is. There's just that feeling in the air of could the market grow rapidly or could it recede, right? Because both are risks. Because one could cause inflation and one could cause high unemployment and disinflation, which are both bad, right? From a fixed asset standpoint. But then there's also the flow of money. We'll cover that in a second too. But just that spread. So that spread has been 2.5 to 3% recently, which means 4% 10-year. You're going to see somewhere around a 6.5 to 7% mortgage rate. That's about been true. This move last week, the 10-year didn't move, but mortgage rates dipped below, I'd say high 5s, low 6s for a lot of lenders. That just kind of removed that gamble, right? It just removed that bet. So again, going to on my heat map of, okay, 200 billion, I just showed you, isn't that much relative to the actual market size, right? It's something, but it's not that much. Same idea of like, if I want to buy Tesla stock, if I put $1,000 in Tesla stock, I probably didn't move the value of Tesla stock, right? Because my portion in compared to the total market size of Tesla, like the market cap, it's just irrelevant. It doesn't make any difference. It's not doing anything, right? The 200 billion is not irrelevant, but it's also not me going to the table with $1 trillion and being like, I want to buy all Tesla stock at $1 trillion, whatever that value is. I might make the market move a little bit. So from that standpoint, it's not the equivalent of what was happening during COVID, pre-COVID, just isn't. So there's still going to be a big market gamble on interest rates moving forward, right? So the 10-year still matters, just some of that risk just got removed right now. So how do we get to a 5% 30-year fixed? If the 10-year treasury spread historically with low volatility is 1.5% ish, then the 10-year treasury needs to be around 3.5% with low volatility for 5% mortgage rates to make sense, right? Here's the downfall of that. What are the outlooks for this year? Outlooks for this year are strong GDP growth, low unemployment, decent wage growth, right? A little bit of a rebound economy. There are some people saying like also there could be a recession. There's always a chance, right? Like, if I go into a football game and say like this team might win or this team might win before the game happens, that's a statistical probability. That just is what it is, right? But then there's gambles on either side. Well, this team's 75%, this team's 25, right? Same thing if I try to make a prediction of like the economy is going to be good this year or bad. What I'm looking at is what are the indicators of this year? There's a lot of growth happening around AI. There's a lot of infrastructure build out, which infrastructure build out is good for a lot of the economy, right? Like that is, if we only looked at one barometer of how healthy is an economy, if as a whole, as a people, a community, a society of people living in an area, if that's us, if that's our definition of an economy and a civilization, United States of America, if we're building as a society and community, there's probably a lot of money flowing around the economy. It's just a statistical fact, right? If we are building, we are also growing. If we aren't building, we aren't growing, right? Like that's just a easy economic barometer to look at to go like, how could a society be in a good position? Remove other nuances and just look at one piece. If we're building, there's probably a big flow of money trickling down from that event, right? Building can be a very good tip of the spear indicator of economic outlook, right? So if we are building out a lot of AI infrastructure, even if there's a fear that it takes jobs, that means that there's also a lot of job displacement because that's creating a lot of jobs, even if the thing that it's creating is also removing jobs, right? Think of like from the standpoint of the machine being invented, the digger, right? So an excavator. It's a job I grew up doing, running heavy equipment. An excavator being created, that turned something that would have been probably thousands of shovelers into 2 excavator operators, right? So you take thousands of shovelers that would have had to dig a hole for something to be built. And now say you have this digger that can do it way quicker and more efficient. Yes, that replaced all the shovelers, but now we need someone to make the digger. We need someone to run the digger. We need someone to maintain the digger. We need someone to create grease. We need someone to make batteries. We need someone to make engine parts. We need someone to maintain it. The ripple effect and displacement ended up being not a 1-to-1 ratio of 1,000 shovelers lost for 2 diggers created. It ended up being 1,000 shovelers lost, redirect over here to, hey, I was a shoveler, so now I understand that industry. I'm going to go sell diggers, right? Now we need people to sell these diggers, right? And explain the benefits. So that's usually how the industrial wave happens. And I think wave is a really good visualization for how in like these industrial changes occur and what the displacement is if you have the mindset of being under the wave, it's going to crash on you. If you have the mindset of riding the tube, which is probably the best position in a wave, not a surfer, I just like watching it, I think it's cool, then that's you saying, I can see the waves happening and I'm going to innovate and get ahead of it. And then there's like the ultimate, which is, I don't even think you really kind of see it. If there's a tube and the what's that, Poseidon, like the Greek god of the ocean, is on top of the wave. Like that's the ultimate, like Caterpillar created the digger and like, okay, now we got to create massive wealth on top of an industrial boom, right? So like if you stay as the shoveler, yes, bad. And I know that this is a weird topic for interest rate discussion, but it's relative to what's the economic outlook look like, right? What are investors thinking as massive amounts of money flow around our economy and go to sectors? if there's potential for good growth this year, then that's a potential for more money to flow into the stock market, which puts pressure on interest rates. Because if I'm flowing more money into the stock market, because I think the stock market might, go up 125%, 150%, that makes buying a 5% mortgage bond very unsexy, right? Like I'm probably not making that bet. I'm probably not going like, hey, my money could grow 150% this year compared to five, right? Like that, it just doesn't wash out. So if we have strong economic outlook, which we do, and we don't have bad economic outlook as the prevailing talking point. I know some people are talking about it, but majority is saying, hey, it's gonna be a good year for the world, right? There's gonna be a good year for the world. World economic GDP should rise this year. That's the pejorative talking point, right? So from that standpoint, back to these two other buckets and the third one, flow of money into the bond market represents interest rates the easiest, right? More money flowing into it, just better for interest rates. 10-year treasury compared to 30-year, that's a representation of economic outlook, economic risk, right? The 10-year treasury is a good representation of, if the 10-year treasury is really low, we probably have a bad economy. If the 10-year treasury is really high, we probably have either a really, really, really strong economy or inflation, right? Like that's just, again, heat maps. So we need the 10-year treasury to go down. Again, back to like, how do we have a 5% interest rate this year at some point? You need the 10-year treasury between 3 and 3.5%, which if the Fed doesn't get involved because the Fed's looking at it and going, well, our sectors are either cruise control, brakes, or growth. We don't need to grow because the economy's humming, right? So we're not going to be a buyer in the market. It's organic viewpoints. Money's going to be flowing over to the stock market because we're in a growth economy. Where I'm getting to all of this is the tea leaves show me there's going to be pressure on rates still to stay elevated, related to Joe Schmo, Jane Doe on the street walking down. And if I just knee jerk walk up to you and go, what's a good low interest rate? I think a lot of those answers are 4%, right? So that's the perceived low rate, which is perception's reality. If that's the perceived low rate, what's it going to cause for real estate? I think it's going to be good for real estate, what's actually happening on the ground with people who are willing to talk to realtors, talk to their financial advisor, talk to their lender, get the skinny of what rates might actually do, good advice, right? Do all of that. But unfortunately, it's still going to keep some people on the sidelines. It's still going to keep some people not pulling the trigger on refinancing, not pulling the trigger on becoming a buyer, because if the perception is 4% what we really want, then 5.75 still feels high, right? So this is still a feeling high rate. It's not what the consumer would want. Again, I'm just basing it off a walk down the street, bump into someone at a coffee shop, and just out of the blue, what's a good mortgage rate, right? Like, I think 3 out of 10 people say to me, hey, rates aren't that bad, right? I think 5 out of 10 of those same 10 say 4, and then I think, 2 out of the 10 punch me in the face because they're like, what are you, some mortgage salesperson, right? Like, I think that's probably a good heat map of if I walked up to 10 random people, which maybe I do that for a podcast, and ask where rates are low, right? So looking at all of that, I think a good gamble for this year, if you're gambling, is take the money and run if you need to refinance, right? Don't overshoot it and think rates are going to keep trucking on down, because we just ran through all of that. That if the economy is strong, which hopefully it's strong, we want strong because we want the flow of wages to fix what inflation caused during 2022, right? We don't want prices going down. We want prices remaining stable, because prices going down is representation of our economy eroding, which isn't good. And that's people losing jobs, right? Like in that Big Short scene where Brad Pitt freaks out every time unemployment goes up 1%, right? Like what, 40,000 people die or something like that. Like 1% of our economy is like 3 million people losing their jobs. Not good, right? Or no, it's probably like 1 million people losing their jobs because of like working age, whatever. So either way, from that standpoint, we don't want disinflation. We want stability. But what we need to make affordability better is we need wage growth and growth, right? To combat how much prices went up. So if prices remain stable, relative to last year, which is what we want, but wages grow, that just means affordability loosens. And hopefully that dynamic holds true and inflation stays low alongside of good wage growth. Because that's really where we want to skate to the puck to say, okay, what's good for the person on the street? The person on the street is that they have excess money related to cost of living, right? Like I think when I think of wealth, that's what I think about. Like if Joe Schmo on the street has some excess money in their pocket so that they can buy some ice cream with their kid and feel okay about it, that's pretty wealthy to me, right? Like you don't need to be a billionaire to be wealthy if that's what you can do on a day-to-day basis, right? So like that's the puck that we're trying to skate to. And that's going to put pressure on rates. If that's still the outcome, that puts pressure on rates, right? We don't want really, really low rates this year. Really, really low rates means something really bad happens, right? We don't want really, really high rates. Really, really high rates means something bad happens. We want to skate closer to cruise control. Cruise control for me is somewhere between 5 and 6 for a 30-year fix. Very low outcome of 5, 6 more realistic, high 5s more realistic, right? That's about cruise control for our economy based on what's happened in the past 20 years, based on what's happened in the past 6 months to a year, and based on projections moving forward economically of what's going to happen with growth, what's going to happen related to the flow of money, all of that, right? What the government making a decision with globally, all of it, right? So from that standpoint, I hope this information is good. I hope that you're able to take this. If you're, again, whoever's listening to this, realtor, client, attorney, whatever, you know, if you had to summarize where I'm going with this, if you're thinking about refining, but you're not going to pull the trigger because you want 5%, not 5.625, I'm not saying you're making a bad choice. I'm just saying you're making a really bad bet, right? Remove choice. You're making the choice, but it's just a bad bet because the numbers don't line up statistically with the potential of rates being much lower than where we are now, right? Just statistically. And that's a bet then. So you're betting on something that doesn't have a good statistical outcome. So it's just a bad bet, right? Same with the buyer waiting on the sidelines, same with the seller waiting on the sidelines. Now, the way you hedge that bet, again, for realtors, everyone listening to this, the way you hedge that bet is talk about discount points, talk about seller credits as we have a weird window here where the market's a little bit slower coming into the new year because of the past 6 months and what the market's done. You got a window now where you might be able to get a seller credit to pay for, discount points. If you're selling a house, talk with your loan officer about net equity and what you have for net equity to spend and the best way to spend that money for the best outcome. It might be paying discount points right now for a 30-year fix at 5.5%. And now you've just, because of everything we just talked about, if you lock in 5.5% on a 30-year fix, even if it costs you some money out of pocket right now, the likelihood of rates much below that number is a slim chance. The likelihood of rates above that number, slightly higher, right? So it removes a lot of risk of what rates might do. And it just means for you to refinance out of 5.5%, you need like 4.5%. And what's the likelihood of 4.5% in the next 5 years? 4.5% is only alongside of a catastrophe. Because then we need the 10-year to be around 2.5 to 3% because of that spread, which means our economy is not in a good position, right? It's just the facts. So from that standpoint, take it, run with it. I hope this is good information. Look forward to next time.